140 data centers were supposed to be built in 2026. That's the number that Wall Street priced in. That's what's holding up the multiples of the S&P 500. Here's the problem. Only about a third of that capacity is actually being built. The rest? Press releases. By the end of this video, you'll know exactly how much of that 140 is actually real, what the debt market is actually telling you that the equity market hasn't priced in yet, and the 3 specific signals traders need to watch before this reprices. If you have exposure to AI and you don't know the completion rate on these projects, you're long a number that doesn't exist. That's not a thesis. That's a bet on a press release. 2026 was supposed to be the validation year, the year all that CapEx spending, hundreds of billions in announced investment, showed up in steel, concrete, and live operational data centers. Markets priced it exactly that way. And why wouldn't they? Every week brought a new headline, a new campus, a new multi-billion-dollar partnership. Here's what actually happened. By the research firm Sightline's count, reported by Bloomberg, only about a third of that announced capacity is under construction. The rest exists on paper. Microsoft alone has canceled or deferred more than 2 gigawatts of planned capacity. Analysts at TD Cowen called it oversupply relative to demand. That's a flagship builder quietly walking commitments back. Then there's Project Matador, a Trump-branded mega project in the Texas Panhandle, later renamed the Trump Advanced Energy and Intelligence Campus. It was co-founded by former Energy Secretary Rick Perry. Within months of going public, the CEO resigned. 2 days later, the CFO followed. Market cap went from nearly $20 billion to $3.4 billion. And there was never a confirmed tenant. The departing CEO's own words, "I will accept this as failure." A data center with a sitting president's name couldn't get built. So here's the number that matters. By capacity, only about a third of the announced build-out is actually under construction right now. Call it the equivalent of maybe 50 projects, not 140. The market priced the dream. The physical world is delivering something very different. Now, a new wave of debt just flooded into this sector through the bond market, and a lot of it is priced like it's dangerous. So who's actually watching what gets built? The AI build-out has burned through its own cash. The hyperscalers and the new AI infrastructure players are increasingly funding this with borrowed money, a wave of new data center bonds hitting the market. Some of this is investment grade. A lot of it is not. Look at what these deals are paying. xAI's data center debt priced around 12%. CoreWeave-backed Applied Digital borrowed near 9 to 10. Those are junk-level coupons, because those are junk-rated issuers. That's the market pricing real risk out loud. And the investment-grade tranches that do exist, a lot of them rest on single-tenant, special-purpose structures. One customer, one building. The kind of financial engineering that looks safe right up until a tenant blinks. If that structure sounds familiar, it should. Pre-2008, the danger was never the junk everyone agreed to call junk. It was paper everyone agreed to call safe. And right now, investors and rating agencies are openly questioning whether these tenant-backed data center structures deserve the grades they're getting. When the market starts second-guessing the rating instead of trusting it, that's the tell. So here's the live signal. Credit spreads on data center debt. When the spread between this paper and safe benchmarks widens, it front-runs the stock. Credit spread blowout is a leading indicator for equity repricing, not a lagging one. Traders who watch data center credit spreads are looking at something the equity market hasn't priced yet. So the capital is flowing, the bonds are moving, but the projects aren't being built. So what's actually stopping them? The assumption is that the constraints are semiconductors and capital. More GPUs, more money, more data centers. That's the framework most are running. Here's what's actually blocking these projects. High-power transformer imports from China went from fewer than 1,500 units in 2022 to over 8,000 units in 2025. Tariffs have now disrupted that supply chain. You can't power a data center without the transformer. The transformers aren't there. Community opposition killed 6 data center projects in 2024. In 2025, that number jumped to 25, a quadrupling, tracked by Heatmap Pro. Maine became the first in the country to pass a statewide data center moratorium. The governor vetoed it, but more than a dozen other states are now advancing their own restrictions. That's regulatory contagion, and it's accelerating. And then there's Sam Altman. OpenAI signed letters of intent with Samsung and SK Hynix together to take up 40% of the world's DRAM output for its Stargate buildout. Non-binding letters. But the signal was enough. AI data centers are already absorbing an estimated 70% of global memory production. A 64 gig DDR5 kit went from $190 to over $700. And when China's memory makers moved to break that pricing power, Micron slid nearly 30% in a matter of weeks. That's how tight this market is. Memory this scarce reprices on a headline. Allbirds, a shoe company, pivoted to AI data center infrastructure. Its stock rallied 580% in a single day. That's the market we're in right now. The bottleneck isn't technology. It's not capital. It's transformers, fiber technicians, water rights, and zoning boards. And a memory market so tight that one policy move out of China can knock 30% off a chip maker in weeks. That's how fragile this supply chain story actually is. Now let's look at what this means at the macro level. Because this isn't just a sector story. This is the whole economy. Here's a number that should concern you. In the first half of last year, one category, the AI and data center CapEx, that shows up as information processing equipment and software, accounted for 92% of US GDP growth. Strip it out, and the rest of the economy grew at a rate of 0.1%. Not 1%, 0.1. That's not growth. The elevated multiples on the S&P 500 rest on the AI is everything thesis. This thesis depends on physical delivery running at roughly 140 data centers in 2026. By capacity, physical delivery is running about a third of that. Regulatory contagion is spreading. More than a dozen states are moving on bans or restrictions, and none of that is priced into the index yet. Here's the framework. 3 signals to watch right now. First, credit spread divergence on data center bonds. When the spread on this paper widens against safe benchmarks, equity repricing follows. Watch the spread, not the headline rating. Second, the state-level regulatory pipeline. Every new restriction is a leading indicator of the completion rate continuing to fall while the announcement rate stays high. Maine was the first to move. It won't be the last. Third, completion rate versus announcement rate. That's the structural mispricing gap. The market prices the announcement. You want to know what's actually being built. You now understand the structural gap. The 140 data centers announced, only about a third actually being built. In a debt market that's already pricing risk, the equity market hasn't. But knowing the repricing isn't the same as knowing what price is actually doing right now, or when this divergence becomes a tradable signal. Here's what that understanding also doesn't give you: the truth about the direction of price. It gives you a narrative, and narratives matter. But price is what tells you whether the narrative is true or not. The measured move is a framework for understanding the direction of price. It tells you whether this story is being confirmed by price or not. If you trade on a narrative without that framework, you could be on the wrong side of a trade for days, weeks, or even months, while price tells a completely different story. That framework is what I teach. The traders in my community use the story to understand their environment. They use price to understand the trade. And when those two things disagree, they follow price. They may be trading in the opposite direction of consensus until price changes and tells them something completely different. They have a process for knowing when that happens. That's the process I teach every day at eminiaddict.com.